Well, good morning, everyone, on this September 2nd. Maybe it's afternoon for you if you're on the East Coast, but great to see you. We're here at Gentian today to bring you your bi-weekly webcast and talk about issues that have gone on. There have been quite a few that have gone on in the last couple of weeks, but we'll talk about the things that are pertinent to you and the things that we think are important for you to know about right now. As such, I'm going to turn over the housekeeping, the beginning portion of this function, which I normally talk about because you hear enough from me. I'm going to turn that over to our team, and today, Mr. Peter Nordenberg is going to go ahead and give us the housekeeping items.
Thanks, Chris. Good morning, everyone. As Chris mentioned, today you get to listen to me, but in a couple of weeks, there'll be another team member you get to hear from. A few housekeeping items, and as a reminder, all of these you will receive emails regarding, but first of all, our offices will be closed on Monday, September 7th for Labor Day. Our next webinar like this will be held on Wednesday, September 16th at 11 a.m. The next Gentian Women's Group virtual gathering will be held on Wednesday, September 23rd at 10 a.m. And then our fall forum, which we typically hold at Blue Mound, unfortunately, we'll still be holding that virtually. That will be Wednesday, September 30th at 11 a.m. So that will fall right in line with our bi-weekly Wednesday webinars. So please watch out for the invitation for that. And there will be a note on there, but if you register by September 21st, you can then keep an eye out for a sweet treat that will be heading your way. And finally, please keep an eye out for the fall online appointment scheduling emails from some of our Gentian team members. Those will be going out in the coming weeks so that we can get you on the calendar for your fall reviews. As a reminder, all of those are still being held virtually, so via phone or via Zoom, whatever you're most comfortable with. But that's all that I have today, so I will kick it back to Chris.
Awesome. Thank you, Peter. And while we're still talking about Peter, before we go on to gratitude, I want to actually make an announcement here that's been really long due and earned quite well, and that is Peter Nordenberg has been promoted in our office to the Chief Operating Officer. So within our team, he's in charge of the day-to-day of the firm. He's been doing a lot of this anyhow. I think the title's well-deserved, well-earned. I know the team has supported him. You guys have as well. So in addition to being the head of a private client as well, which many of you talk to Peter on a continual basis, we wanted to make sure that the designation of his title was actually appropriate with what he did. So I wanted to take an opportunity here to say congratulations to Peter. Thank you for all your years of service, 13. I'm going to call it like 26, just because it's more fun to double it over time. You probably contributed that much over this time, but we all appreciate that here. So if you want to reach out and congratulate Peter, there'll be an announcement going out in our newsletter in the next couple of days as well that you'll see. So I wanted to go ahead and just let everybody know that the phenomenal promotion has occurred with Peter Nordenberg, our team. So let's give him a hand. If anybody can see you, I'm giving him a hand. There's everybody else who's on the screen too. So thank you, Peter. Thank you tremendously. It's awesome. It's awesome. So today I want to start with going big. Of course, that's how we always begin. Going big is, of course, just us stopping for a moment and appreciating things that have occurred for us. The month of August is pretty sparse for me. Usually I attempt to do some different things with the family, refresh, learn, and take care of items that you don't normally get to during the season. So for me, my gratitude is really the team and taking over the portion of this. I've also got another piece of gratitude that I'll share at the end here, a very, very important one. But I wanted to tell the team, both also my family, which I got to spend a week with in the UP of Michigan. It's kind of an interesting fact that in about a 5-week span, almost everybody on our team will have been near Iron Mountain in the UP. I don't know how that is or why it is, and it wasn't coordinated that way, but it's interesting that all of us will have been up there. So beautiful country, but I wanted to say that my gratitude goes to that, to my daughters who are now doing online school and adopting. And I've talked a lot about adaptability, and it's a lot of words until you actually see it in action. And when your kids begin to become adaptable to whatever's hitting them, you start to notice that they've actually been listening. So today they went online for 2 days. Next week they're going in person. So I just wanted to congratulate them as well. Belle and Sam, who are now 14 and 11, and a freshman in high school, and a 6th grade middle schooler. So it's been phenomenal. So with my gratitude, I want to flip that over to Ken, if I may.
Yeah, thank you very much, Chris. Hello, everybody on the call today, and those who will watch it in the future. Just want to say we miss all of you. We look forward to talking to you during our reviews and just random phone calls that we do make to you. My gratitude goes out to help. Chris just mentioned going virtual right now. you know, maybe if you're in a position where you can help a family member with the online virtual learning right now that's going on in schools, if that is your situation, go ahead and take advantage of that. You know, reach out to your kids, reach out to your grandkids. If you're in a position that you can help, that help goes a long ways. You know, there's 2 of us in our household with 4 kids on Zoom calls. I'm not quite sure how we do that, but that's where the help comes in. So if you're a grandparent listening to this, just think about that piece. If you're able to help, go ahead and help, because your kids, your grandkids will very much appreciate your help and your reaching out. So that's my gratitude for today, is just people helping people. And I'll kick it back over to Zach. So Zach, what is your gratitude for today?
Thanks, Ken. I appreciate it. I don't necessarily have one specific thing, except on Saturday I had the opportunity to enjoy the beautiful day and ran for about 6 hours at Leapham Peak in Delafield. And as I was running, kind of had, I always talk about how grateful I am, but it hit me extra hard that day for my family, how I was raised, my parents, everything they've done for me, and also the family that life has given me, which is the Gentian team here, as Chris mentioned. Unbelievably grateful to work with these people that you see and that are here at the office. And also the other family that I've been given is each of you guys. During that 6 hours is a long time in your head. And I honest to God thought about almost every single one of you and your families and the stories you share. And it almost brought me to tears of how grateful I am for all of those stories and to have the opportunity to work for each and every one of you.
Thank you, Zach. I appreciate that as well. You can see, again, a lot of what we do is really for you as clients. I know Zach just echoes the feeling that we have, but just for anybody who wants to know, Zach is training to run an ultra marathon. I think it's 60 miles or something like that. It's some ungodly number, which I've never thought of running, maybe driving that far, but he's actually going to physically run it, which is absolutely amazing. So the discipline he shows is also in what he does. It's not just what he says. So pretty interesting fact. We'll talk more about us individually at some future time. But I wanted to start a little bit today with something I call the round trip. So right now you've seen the round trip. You've seen it in 6 months. You've seen the full bore of a correction and recovery to new peaks and new highs. So what does that mean? Well, what does that mean? I mean, what have we learned from it? What can we do with that? I've had a few people from time to time now be with some friends going, I think I should sell, I should do this or that. And I think that if you look at some of those, we can be a little bit short-sighted, but you're going to have a lot of opinions going on right now about markets and what's going on. So we've talked about it before. I'll touch base a bit on it today. But a couple of things that I looked at this as well. We've learned some things from it. So I wrote some notes down about what those are. And a few of the things that we have is, first of all, number one, the market can never be timed. A black swan event is unpredictable. Recoveries are unpredictable. The one thing that we know about them, though, is they typically resemble the downturn. So a 30% downturn, the quickest ever in about 30 days, was resembled by the recovery that you saw as well. But remember, this is a phenomenal time for us to go back to what happens in corrections. We'll talk more about that piece as well. Also, the declines of this size, if not in speed, are as common as dirt. They happen about every 5 years. So when we're on this ride, we know our stocks change happening on a very consistent basis. That's number two, or letter B, if you will. You can never know how a market crisis will end, but you can be sure that they will end. If you study economics and markets long enough, you've seen market corrections and crises always do end, and they end in a crazy and phenomenal way, and they move forward. Another is equities remain the only way most of us are ever going to achieve our goals. So that's an important piece to know as well. So having the appropriate portion in great companies is extremely important. Lastly, stocks remain, for us anyway, realism is the only, optimism, let me flip that around. Optimism is the only realism. So when you look at that piece as well, optimism being the only realism, you look at this and say, if you look back at history, the only thing you could have if you study enough history is optimism when it comes to markets. There's all sorts of other subjects. This discussion was only about the market, but I wanted to let you know that albeit this was at a different speed, meaning it was very quick, all in 6 months, it was a full bore bear market. You saw it, you saw what to do and saw what not to do. I think I reiterated this last time. What if you made a move at the bottom on March 23rd? What if you decided to make a move out of equities? and you were trying to get back in. I also want to say something as well. To many of you, we really applaud you staying in the market. I do have a question, and this question comes up, which is, if you've been given 4 more weeks and 10% more down, would you have decided to capitulate? Would you have wanted to do something about it? This is where you begin to test yourself. So another 10% down, another 4 weeks. How about another 4 months? How about another 20%? That's what happened, if you will, in the corrections of the past. But we have to be prepared for these. We want to know what they are ahead of time. So when they occur, we behave in a way that's beneficial to our plan and our long-term goal. It's why we have the portfolio set up the way we do. And over time, you're going to see some great pieces from Ken and Zach as we talk more about those as well. But what was not different on this is the effect on human beings. You saw pathological fear. You saw media-induced fear. You can blame it on anyone you'd like to, but the only person who reacts to what's going on is you, the individual. So to you, all of you who've held on, all of you who didn't try to time it, it's really been a phenomenal ride. And thank you for your trust in us, because I know some of the conversations aren't easy when you trust us. You're going to be talking with some of your banker friends or some of your other friends who are real conservative. Oh, we got to do this. We're going to get out. We're going to stop. You got to be careful with that, because they don't have your best interest at heart. They're looking to preserve capital, which is actually a way to run your money down over time. So there's some things we'll talk about more individually, but I just wanted to go through a few of those pieces that we've seen as well, and really looking at what I call the round trip. We'll talk more about this. We're going to summarize. There's 10, I'm going to call it lifetime investment, and it's a great thing I've used from Nick Murray over time, but it's been outlined very well. I'm going to let Ken and Zach talk more about the markets and some of the planning, and then I'm going to come back and list those 10 lifetime investment principles that you should get from this as well. So we're going to call today probably your 10 lifetime investment principles, and maybe call it the round trip. That's what this is going to be today. So this is a bit more market derived than normal, at least from the portion that I'm going to talk about, but I want to turn this over because I think Zach has some phenomenal market statistics to talk about as well if we can. So thanks, Zach.
Thanks, Chris. I appreciate it. We'll just run through some of the major indexes returns for the year, and then just a couple 4 highlights that you maybe have heard about, or we've heard from you guys that you'd be interested in hearing a little more about, which is the Dow Jones kind of shakeup, just new funds out, new funds in, a couple notable stock splits recently, and a couple of tech companies that have done extremely well through the coronavirus, and then just a few market S&P 500 facts looking on the last 94 years. So first, just looking at the market year-to-date returns, the NASDAQ year-to-date is 32.62% up throughout the coronavirus. The S&P 500 is now almost 10% at 9.48%, and the Dow Jones recently just flipped positive at 0.87% year-to-date as of this morning. All those numbers are as of this morning. The first highlight, the Dow Jones shakeup. Again, the Dow Jones is a price-weighted index. I emphasize that because that's important here in a second, and you'll see why. But it's a price-weighted index of 30 stocks representing different sectors throughout different industries. Recently, a company that was in the Dow Jones component for almost a century is now out of it, which is ExxonMobil, and it's lost about 40% of its value due to challenges that it's seen recently with fossil fuels, etc. Pfizer is now out, and Raytheon Technologies. Again, none of these are recommendations of any kind. It's just letting you know that what you might have heard in the news as far as companies that are out of the Dow Jones. And then 3 companies that are replacing them are Salesforce, which is a cloud computing company, Amgen, which is a biotech company, and then Honeywell International, which is in the aerospace and industrial. Some of the changes may have occurred because of some of these notable stock splits that I'll mention next. And 2 of the more notable ones recently are Apple, which had a 4-for-1 stock split. It's the 5th time Apple has split. I went from about $500 a share to about $125 a share with that split. And the reason why I emphasize the price-weighted index for the Dow Jones is that Apple was the highest weighted because it was about $500 a share, its price, to the 16th highest weighted in the Dow because of now its share price of 125. And kind of just a fun fact, just to show you how the price weighted matters, is that the the 3 highest weightings in the Dow Jones are United Health, Home Depot, and now Salesforce, one of those new companies. So it's just really interesting. Again, the S&P is market cap weighted, That's why Apple is the biggest inside of the S&P 500, but the Dow Jones is price weighted. Tesla was the other one, which was a 5-for-1 split, $2,000 a share to about $400 a share. And then the next little highlight is just kind of the Zoom boom. Well, poet, I didn't even know it. I'll take Chris a run for his money with his poetry that he shares with us once in a while. But again, this isn't a recommendation for Zoom. It's just to show an example of some of these companies that have done really well throughout the coronavirus, and also to give us a little caution sign with companies like this that we're going to start hearing more and more about, and that might be flocked to during these times as well. But on January 2nd, Zoom was worth about 16 billion, and as of this morning, is worth about 120 billion, which is larger now than some very large companies that have been around for a while. It's larger than Boeing, Lockheed Martin, and Twitter is viewed as a large social media giant. It's almost 4 times larger than Twitter as of this morning too. So just incredible to see. Again, not a recommendation at all, just to give you an idea of some of these internet companies. Then just a quick couple S&P 500 facts. This is from Dimensional Funds, The Bumpy Road to Market's Long-Term Average. From 1926 to 2019, the S&P has returned an annual compounded average of 10% per year. It's ranged in returns from positive 54% to down minus 43% during some of those years. Here's the key point that we wanted to make with this one, and was really interesting when we looked at it, is only 6 of those 94 years were within 2 percentage points, either below or above 10%. So it's a very bumpy road on the long way to get that 10% annualized return, and is extremely important to note looking forward. And 69 of those years have been positive, and 25 of those years have been negative. So those are, again, just some year-to-date returns for the markets, and then 4 highlights that we wanted to make note of since our last webinar.
Awesome, thank you, Zach. That's phenomenal. That's phenomenal. Matter of fact, we're on Zoom right now. Again, that's not a recommendation. It's just a company out there. It's amazing to see. Sometimes once things become a verb, you start to look at them a little bit differently. So it's interesting to see as we go along. But Ken, I'd like you to share some of your great planning principles and ideas and things you've been seeing as well. I know that we've been talking a lot about those, but I want to turn it over to Ken.
Thank you, Chris. Appreciate it. What I'm going to talk about today is I'm going to show you something called a Calend Chart, and it really talks about the variability of investment returns for different asset classes over different periods of time. So I want to show you that, and I want to talk a little bit about the Vanderbilt story versus the Rockefeller story. That really parlays into what we call legacy planning. A lot of you, and we've been talking about this together, about, you know, what do you want your legacy to be? You know, once you're in retirement for a while with us, and a lot of you have been, but those who are new to it, eventually we get through a honeymoon stage of it. We get through the idea of, is income going to be there for us? The answer is yes. We've already thought about this for you and with you. We've taken the things into consideration. We have different buckets that are appropriated for income that you're going to need. But once we get past that, 10 years into it, 12 years into it, then this idea of legacy comes out. And I just want to talk a little bit about that, what that may mean for you and your family. If you haven't thought about it, maybe you're starting to think about it. I have taken a trip this year to Saint Germain for the 2nd year in a row. It's tradition now. So I'm going to talk about that in a second here. So what I want to show you, though, is I'm going to give you a quote from Peter Lynch. Peter Lynch was the greats who ran the Magellan Fund, the Fidelity Magellan Fund, for a long time. And he says, if you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes of your day. So I thought that was pretty funny. So I'm going to share my screen with you for a second here. Let's see if I can find what I want to share. And give me 1 second here. There we go. Should be able to share with you in a moment here. There it is. All right, so now you can see my screen, and you see a lot of different colored boxes on here. And the reason why this is important to talk about is that we're hearing a lot from other people out there that are talking about how their returns have been really, really, really great this year. And a lot of your returns for our clients that are listening, you're back to where you were and then some right now. But if you own just large companies through all this, you've really fared pretty well. And it's what I want to show you, though, is that large companies don't last forever. Large companies will not be the best performing sector that you own in your portfolio forever, as evidenced by this Calend chart that is put out by Raymond James. And I just want to highlight a few pieces here. I'm going to annotate a little bit. I know this is a little different part of what we do for a Zoom, but what this does is it goes from the 2000s all the way to 2019, year by year, as you can see up on top there. And what it does is it shows you what the best performing sector was of the overall markets, if you will, and then what the worst one was for that given year, you know, for the column there. So as you can see in 2019, last year, large cap growth definitely was the best performer. We also pair up large cap value in your portfolio, as you know, we're growth and value. So value, as you can see, if you kind of look at the green pieces here, has lagged a little bit from large cap growth, which I'm circling right now. Large cap growth is what I'm circling right now. So just a little piece on that. So stay diversified. Diversification is the formula. When you look at 2017, emerging markets was your best performing sector at that point in time. A year before that, small-ish type of company that they call it SMID, if you will, SMID value was the best performing sector at that point in time. A year before that, real estate. Then all of a sudden small growth came into. So the whole point of it is that these sectors change over the years. That's why we incorporate these into your portfolio. So when we talk about diversification, that's what we're talking about, because we never know which sector is going to be this best sector for the year. That's why we diversify. Does that make sense, everybody? So I'll stop sharing my screen there. Appreciate you following along with that one. The other piece that I want to talk about is the Vanderbilt story. This is a fun one. You know, you look at Cornelius Vanderbilt back in the early 1800s. He controlled and was worth more than 20% of the overall money supply at that point in time. 20% of the money supply. That's a massive amount of wealth at one point in time for one family. There was a reunion in 1973 at Vanderbilt University, and there was not 1 million there in attendance. What happened? What happened to that legacy? What happened to that, I'll call it the river of flowing of funds down a generation after generation? It probably was one of the greatest fortunes that were ever built, and one that was the greatest dissipated over the 100 or 200 years that you're looking at there. So why is that? And so when we talk about legacy, and a lot of you that have been with us, like I mentioned before, in retirement for a while, you know that you have pretty much, if you're spending the appropriate amount, that 4 to 4.5-ish, maybe even sometimes 5% of your overall portfolio on an annual basis, you know that you have about the same amount of money that you did when you started. And so that is the formula. Why do you have that? You have that because you didn't shy away from equities when it mattered. You kept equities in your portfolio. You've also kept a proper amount of income producing investments in your portfolio as well. We thought about that with you. But you didn't shy away from equities. That's the point. That's the formula. We know equities really give us a great rate of return over a period of time. And so that's something to keep in mind for yourself. Keep in mind also for your family members. So if you're thinking about your legacy, make sure that we have equities in our portfolio. It really is the key to success. So the other part of it is what lives on forever is traditions. A lot of you have shared with me the traditions that you've experienced with your family 30, 40, 50 years ago that you're still actually doing today. I find that to be remarkable. And so those are the stories that are living on forever and that you're still talking about. So when we talk about, you know, what do you value more than money? What wouldn't you trade for more money? Those experiences and health and family and faith really come up to the top of that. And so keep up with those traditions, keep up with, or even create a new tradition that you think would be really nice for your family, because those are the stories that live on forever and ever and ever. Chris, I'll send it back to you.
Thank you, Ken. So what I promised to give you, and I have to do it here in a quick fashion, is I want to give you 10 lifetime principles that are going to be super important, I think, for yourself. Now, we're going to send this. Nick Murray actually put this together, but it's a principle we've also sent out to you at the beginning of every year and in the mid-year letter as well. I highlighted a few of these, but I wanted to give a few of these to you right now because these are extremely important, and this is the kind of a crisis where you see people maybe making a lot of bad decisions out there, like I talked before. Remember, almost 30% of people 65 and over sold all their stocks during this correction. I mean, think about that. How do they feel now? you've missed out on a ton of the recovery. When this is an important portion for those long-term goal-focused investors to really study and understand these 10 principles. I'll go over them fairly fast. I won't belabor any one of them, but I just want to list what they are, and you will be familiar to you. So again, I'm not going to belabor them as I go through here. But as we look at number one, let's really look at what happens is dramatic items come from deep left field that affect the market, and they're completely unpredictable. So you look at these, and that's lifetime investment principle number one. The things that most surprise the market, and I've talked about this, are the unknown unknowns, the things that you don't know are coming. Now, if you don't know they're coming, there's no way to predict them. That's by definition number one. What's also really interesting about this is at the onset, experts have as little information as you do about them, yet they tend to make predictions on a constant basis. So you're going to see them extrapolate unbelievable things that really don't end up occurring. So that's number two. Number three is that the media predicts the unfolding of the economic situation for every individual in America on an ongoing basis. I've seen these three things. They've happened in this correction as well. I want to make sure that you understand those as well. Number four, corrections or downturns of 1/3 are as common as dirt. They happen fairly often, about every 5 years. To be in stocks and equities is to understand that you have to get through those over time. So to those who think it's a low risk possibility, it's not. You need to understand that these are temporary yet necessary as well. Number five, never underestimate how much ammunition the Federal Reserve has. The Federal Reserve decided to back and be the lender of last resort. And the day that they mentioned that, March 23rd, the market turned up the 24th and beyond. So never underestimate the Fed as well. Number six, simple, bear markets end. Simple as that. They end. Bear markets have always ended. Number seven, I'm going to say the recovery is often as quick and as powerful as the move down. If it's a long-term move over time, it comes down over a year or two, you're going to see the recovery be somewhat similar. It's a very quick snap down. You're likely to see a very consistent upturn as well. And don't take my word, there's a lot of research that goes behind that as well. And I'm not saying that about any future predictions. I'm just saying they tend to resemble each other, the downturn and the recovery. Number eight, really looking at this, neither the decline nor the recovery can be timed or known. Talk about those people who sold, who capitulated during that downturn in the March timeframe. Let me say if you had $1 million and you missed 30% of the upturn here, that's $300,000 for the decision that you made. So you didn't lose anything unless you sold. You've recovered at this point as well. So looking at some of these are important. Number nine, equity markets recover long before the economic picture brightens. So right now you're seeing the economic picture look crazy. I've had a lot of people reach out to us. Ken has, and so has Zach and Peter, and they're reaching, oh man, the economics, there's no way this could look good. And your friends are talking about how bad it could be and the market's going to drop. Oftentimes the market, and historically, has been a leading indicator. And that's a jargon to say it tends to be show you what's going to happen 12 to 18 months out. So that's what it's looking toward as well. So number 10 is declines are common. Basically, they're fleeting and they're not timeable. So for a long-term goal-focused investor, which is a lot of you, there's no need to time them because it's built into your plan. You know they're coming, you know they're going to be here. You do have emotions and we get it. The emotions will be affected by this and we understand that piece as well. But probably the best idea is to write it out. There may be a couple small things we do to take advantage of them and adjust, but we want to make sure that that's one of the most, and probably the most important. Maybe we give a lifetime investment principle number 11, and that is don't sell. Don't sell during downturns. It's not the time to do it. If you want to sell a bit during some of the upturns, if you will, for items that you need, but as long as it's part of your plan. So there's 10, you're going to see them in the client corner that we send out in the newsletter coming up as well. But I wanted to reiterate those because they are really the principles we send you in the beginning, in the middle of the year. And what Ken was just talking about with legacy, if you want to give a legacy to your grandchildren, to your children, it's to teach these lifetime investment principles to them. They need them and almost nothing else. And I mean that. They do need thrift. They do need capital. We're going to talk a bit about some of those in our future programs and probably in our seminar. We're going to do our webinar, if you will, at the Economic Forum in September here a little bit later. We'll go through some more data and more of the charts like Ken was showing. But I want to make sure that you understand, one of our goals is to give you the tools then to pass that legacy on to your grandchildren, to your children. And you'll see that by a lot of us helping your children and grandchildren as well, because we understand that you oftentimes will look to them as being some of the most important things. And probably one of the biggest questions we have for people right now is, wherever you are in life, and we're going to be asking this in our program, is what do you want from here on out? What's important to you from here on out? And how can we help you establish a framework that allows you to accomplish that? That's who we are. That's what we do here. I want to make sure you know that. The statistics Jack gave us, the planning and the legacy Ken was talking about, it's part of what we've been doing and talking about for a very long time. We're looking for true wealth. We understand money's a resource to support everything else that's important to you as well. So don't get us wrong. We understand finance. We want to bring up these other ideas as well. Now, the last thing I want to be, instead of ending today with some pithy economic issue, what I'd like to do is express my gratitude, which I said as well. So I wrote a little thing because tomorrow I celebrate 20 years with my wife. So it's 20 years of married bliss. So what I want to start with is just what I wrote, and that is a very short piece here for you. And it's most importantly, gratitude. Tomorrow I celebrate 20 married years with my spouse. The union of souls occurred almost well before that, almost 29 years ago, but the marital union occurred 20 years ago. Most of all, I'm grateful for all the experience we shared, and I appreciate more and more each year your love, patience, support, guidance, laughter, joy, and the rough times. Most of all, I appreciate that God let me go from one great woman to share my life with another strong, great woman. Whatever life may bring to us in joy and elation, I know it only pales to our next destination. I'm fortunate to have such a great godly wife, parent, and soulmate to share my life with. God is above all, his love is above all, but your love is the center of our family and my heart. That's to my wife. So I know it's a little different to share at the end of this, but I just want to make sure, understanding that everything I've done here at this company, our team, our family, is really centered by that relationship with her as well. So I just want to make sure that you understand it, that I appreciate it, that I'm grateful for it. It's very deep and it means a lot to me. So with that, I appreciate you being clients. I appreciate all you sharing, as Ken said, your stories and your lives with us. I really but again, we're very serious with our guidance with what we do and how we help you. I think that's an important piece. We're committed to you. Wealth management is what we do, but getting you through crisis is who we are. That's really what we believe here at the company at Gentian. And thank you on your behalf from everyone here, from all of our team, from everybody who didn't see, from everybody you hear about. They are all extremely grateful for you as well. And stay safe, stay positive, and be grateful. And hold on one moment. I'm not going to end here because there was one question. There was not a question. There was a cool. So the cool thing about this, we can see comments on here as well. So I had a couple of comments saying blessings to our family. So thank you. Thank you very much. So with that, I want to thank you all tremendously. We have, today I want to apologize a little bit too, and I mean that there is about 125 things I wanted to tell you today, and I literally mean it. I've got lists of stuff, I got these things, I got some slides I was going to show, but I knew with everything we had, there's no way I would be able to share it all. We'll put a lot of it in the September 30th program. I also may just do one in between now and next 2 weeks. If it hits me to say, hey, listen, let's put these 5 or 6 things, we'll just record it and send it out to you. Because this recovery, this 6-month period of time, we started this year looking so phenomenal. The first economically, everything was great. 2020 was going to be all about the positive, right? And then out of left field, we're hit by something. So I think it's a phenomenal piece for us to study, talk about, and see what we did, and then cement why we've been successful with it. What have we done that's right, and what won't we do next time? So again, thank you again. I appreciate it. We appreciate you here at Gentian. And with that, I will let you have a wonderful, wonderful Wednesday. And for those listening here in the future, you guys have a wonderful day as well.